Hi, I'm Aaron Rubin, your financial advisor, and I'm here to talk to you about the third quarter of 2013. It ended kind of rough with all the questions about government shutdowns and the debt ceiling, but in general, it turned out to be a pretty good quarter. We'll get into the numbers in a second. I'm also going to talk to you today about active management and why maybe we should consider passive management as our main method of investing. Hope you enjoy. Let's get started. From July 2013 to the end of September 2013, the market did well. Green arrows going upward are a good thing. And again, almost all categories were in that particular position except for U.S. REITs. U.S. REITs have been doing well for a little bit, but again, it's a different kind of correlated asset, so you never know when it's going to act differently than the others. You can tell in the 1 year, the U.S. is still doing better than international, but over 10-year periods of time, international is doing better than U.S. Again, this is another great example of why you should be well diversified between international and domestic stocks. Now, we also have bonds that were also up on the quarter. Not bad. Now again, the bonds that we primarily invest in are those which are relatively short-term and high quality, so you're never really going to see a big spike, hopefully, either upward or downward. Looking at a set of well-diversified portfolios, our intuition is pretty much confirmed that the more you had in the stock market over this last quarter or last year, you did a lot better. Now, that isn't to say that if you weren't as much in the stock market, you should today switch. Again, the most important part is that we have a very long-term approach to our investing. Again, if we look at the 10-year, again, the 100% stock portfolio outperformed the 75% in stocks, 25% bond portfolio, but it also took a lot of volatility as measured in that last column there. So if you weren't able to withstand that movement and you were in the wrong portfolio and you end up getting out of the market, you could have really done yourself some serious damage over that 10-year period of time. Sticking it out, it worked out well. But again, be sure that you're in the right portfolio for you. With our mini review of the market over, let's start talking about active versus passive management. In active management, we're trying to pick stocks or time markets. In passive management, we're definitely not trying to do any of those things. If we take a look at the 10 best days and 10 worst days in the stock market over the last 40 plus years, we find that 5 of those worst days happened in 2008. 8 of the best days happened in the 2008-2009 Great Recession time period. Again, what this is trying to highlight is that if we're trying to pick stocks and we're trying to do better than the other guy, shouldn't we have advisors, or shouldn't there be advisors who can do that for us, who have their MBAs from some pretty impressive places? As you can tell, the guys from the really big impressive universities didn't do so well. Now, the S&P started in 2008 at 1468, and around January 1st, a bunch of very high-powered, very important stock pickers were asked what the S&P would be at the end of 2008. And almost all of them, and actually all of the ones we posted here, said the S&P would go up. What ended up happening? The S&P was cut by almost 40%. So again, even the experts get it wrong in a big, big way. And so it shouldn't be surprising at all that active managers in 2008, on average, underperformed the S&P by almost 1 2/3%. These are the people that are paid a lot of money to not be underneath the benchmark. And in 2008, Standard & Poor's did a study and concluded that active management is not actually as good in bear markets as some people would like to think, and similar results were found for the 2000 to 2002 tech bust. Again, putting your faith in an active manager is truly an act of faith. Even over long periods of time, these active managers cannot beat their benchmarks consistently. International active managers only beat their benchmarks 34% of the time, all the way up to short-term international fixed income, where only 13% can beat their index over a 5-year period, which is the great bear market of 2008, 2009, all the way to the great up markets we've had in the last couple of years. Again, what this is to say, the experts, the guys that are doing the stock picking, they get it wrong an awful lot. And so many times, the financial industry tells us that we should go out and try to pick a fund manager thinking that they'll do better than we can or do better than the market. And the answer is that simply is not true. That really, it is a bunch of marketing at the end of the day. And for the most part, these active managers, which are billed as money makers, well, they often fail to deliver. And so as investors, buy and hold doesn't seem like such a bad strategy. After all, active management doesn't seem like it works. Stock selection and concentration can be very dangerous if one particular stock takes a dive that could really blow out the portfolio. And the other option of just not investing at all, well, now you're just asking for inflation to take away all of your earnings. The most important thing about passive investing is rebalancing regularly. Rebalancing being as important as it is, we need to keep a couple things in mind. First of all, you want to have your balancing be as automatic as possible. Now, I know this slide says set it and forget it. I wouldn't recommend quite doing that, but be sure that you have a reliable, automated process to rebalance your portfolio so that when your equities or your fixed income is out of whack, everything gets bought and sold so that you're within your risk tolerance. You also want to have all emotion removed from that rebalancing decision. It's really easy to watch the news and get discouraged and make really bad investment decisions. You don't want to listen to the news and start making trades. That's a bad thing to start doing. Whether or not you rebalance monthly, quarterly, or annually, research shows it doesn't make that big of a difference. The important thing is at least annually you make sure your equities or your fixed income aren't very far out of line. Finally, make sure you're true to yourself. If you have a long-term perspective and you can take the risk, being more in equities may make sense for you. But if you can't take that risk, the worst thing you can do is pull the plug on an all-stock portfolio at the worst possible moment, because recovery ends up being nearly impossible. We have to keep our attorneys employed somehow, so here are disclosures about the information that you've seen today. As you can tell, active management is a very tricky thing that not many can execute successfully. And how can we be expected to choose the people that can choose correctly? Again, I don't think you can do it on a very consistent basis. In my opinion, it's better to stick with the market return than trying to outduel the market. I hope you found this enjoyable and informative. Any questions, please email me. You can also visit my website at www.warburgrubin.com if you have other questions about investing or budgeting or anything to do with money. Thanks.